Welcome to the Deep Dive. Today, we're plunging into, well, the incredible pace of change that's impacting pretty much everything: your personal wallet, global markets, the cutting edge of tech. It feels like the world is moving at warp speed sometimes, doesn't it? So, this deep dive is all about helping you navigate that whirlwind. We're looking at the latest economic shifts, those dizzying leaps in AI, and some pretty significant corporate developments, too. We'll dig into how global events are hitting local economies and, your own finances, trying to uncover the stories behind the headlines. Our sources for this, they come from a stack of recent updates, primarily from CNBC, covering September 16th and 17th, 2025. And our mission, basically to cut through all the noise, give you a clear, concise understanding of what's happening, why it actually matters, and maybe point out some connections you hadn't seen. All right, so let's unpack this first big piece. After much anticipation, the Federal Reserve finally made its move. On Wednesday, the FOMC, that's the Fed's main policy group setting interest rates, they cut the benchmark rate by a quarter percentage point, 25
Yeah.
basis points. That puts the overnight funds rate in a range between 4% and 4.25%. Now, this was largely expected, right, by investors, economists. It's the first cut since last December. But what was the Fed actually signaling with this move? What were they saying?
Yeah, exactly. And what really stands out, I think, is the economic outlook they gave alongside the cut. It paints a pretty nuanced picture. The committee noted sluggishness in the labor market. They observed that job gains have slowed and the unemployment rate, it's edged up, but importantly, remains low. They also said economic activity has moderated and inflation has moved up and remains somewhat elevated. Still sticky. And Fed Chair Jerome Powell himself, he called this a risk management cut, almost like, an insurance policy against a really sharp economic slowdown. He even acknowledged, and this is quite something, there are no risk-free paths now. It's not incredibly obvious what to do. That's a remarkable admission, isn't it? Signals real caution.
No risk-free paths. Yeah, that's powerful coming from the Fed chair. And it leads to this question. If the leadership feels that uncertain, what about the internal disagreements? What does that dissent and the wide range of forecasts in their dot plot, what does that tell us about how confident they really are about where things are headed?
That's a really critical point. You have the newly confirmed governor, Stephen Miron, as the sole dissenter. He wanted a bigger cut, half a point, 50 basis points. And that dot plot, it's basically an anonymous chart showing where each Fed member thinks rates will be in the future. It's key because it gives us this rare glimpse into their thinking, their consensus, or maybe lack thereof. And this time, it shows a really wide range of opinions. You've got some members seeing as many as 4 cuts in 2026. But the official outlook, it suggests just one more cut next year. So yeah, it tells us the path forward is definitely not clear-cut. There's real disagreement inside the Fed about the right pace and scale. And, it's probably worth a quick mention. There's always that political backdrop. President Trump has pushed for cuts in the past. And remember his attempt to remove Governor Lisa Cook,
Yeah.
blocked by the courts. Just met another layer.
Okay, so after all that high-level Fed talk, what does this actually mean for you, the average person listening? Sounds like a bit of a mixed bag, but maybe a moment to be strategic.
Absolutely. It's definitely a mixed bag. This subtle shift from the Fed, it does create this, well, maybe narrow window for being agile with your finances. For borrowers, generally, kind of positive news. If you've got credit cards, especially with variable rates, those interest rates will likely follow the prime rate down, though, let's be real, APRs are probably going to stay near 20% into next year, so still high. Auto loans. Mostly fixed rates, but if you're getting a new loan, you might benefit from lower borrowing costs. And even a small cut like this can sometimes, boost buyer sentiment a bit. And maybe some relief for variable rate private student loans too. They could see rate reductions pretty quickly.
Okay, so that's a potential plus for borrowers. But what about the other side? People trying to save money or maybe thinking about buying a house.
All right, that's the tension. Mortgages. They don't directly track the Fed rate. They're tied more closely to Treasury yields. Right now, the average 30-year fixed mortgage is around, 6.13%? That's down from over 7% back in January, which is good. But a single small cut like this one, it probably won't have much immediate impact. If we see a series of cuts through 2025, 2026, then yeah, that could gradually bring rates down. But remember, if you have a fixed rate mortgage already, it won't change unless you refinance. And for savers, well, the old saying holds true. Rate cuts are good for borrowers, but kind of tough on savers. You should expect yields on those high interest savings accounts, CDs, the ones that have been over 4%, they'll likely start to drop. So the advice from experts is pretty clear. If you're a saver, you might want to act relatively soon. Lock in today's still pretty high rates before they fall further.
That's a compelling point. Act now. Okay, so beyond personal finances, what about broader economic signals? We saw that sales of heavy trucks in the U.S. were down quite a bit over 15% in August compared to last year, 21% from 2023, a four-year low. Historically, that's often been seen as like a leading indicator for recessions, right? Signaling slowdowns in manufacturing, building. Should we be worried?
Well, it's a valid point if you look only at historical patterns. But what's really fascinating here, I think, is how these traditional indicators might mean something different now in this, rapidly digitizing world. Some economists are suggesting this drop in truck sales could also reflect the economy shifting, moving from bricks to clicks, as they say. So less focus on traditional manufacturing, more on services, digital activity, a lot of that driven by AI. Kind of challenges us to look beyond just the old correlations and think about how AI is maybe fundamentally reshaping the economy's infrastructure needs.
That's a really interesting take, how old indicators might not tell the whole story anymore, which actually leads nicely into our next segment. How are geopolitical tensions and tech shaping things, especially with the U.S. and China? Let's dig into that.
Absolutely. Geopolitics is, it's massively shaping the tech landscape right now. Let's start with TikTok. Apparently, a framework deal has been reached between the U.S. and China about the platform. Presidents Trump and Xi are expected to finalize it on Friday, which could potentially stop that September 17th divestment deadline from kicking in. It really shows that delicate negotiation dance between the two powers.
And it's not just TikTok, right? There's the broader trade picture.
Exactly. U.S. Treasury Secretary Scott Bessent said he expects more talks before those really punitive tariffs, 145% duties on Chinese imports, are supposed to hit in November. Remember, those were already delayed from April to allow for these talks. It just underlines how tangled up economic policy and international relations are.
Definitely. And that brings us right to the chip situation, the AI chip ban.
Yeah, the ongoing chip war. It's a prime example of this strategic competition. China's Cyberspace Administration reportedly told tech companies ByteDance, Alibaba included, to stop buying NVIDIA's RTX Pro 6000D AI chips. Now, this was a chip NVIDIA made specifically for the Chinese market, trying to comply with earlier U.S. restrictions. NVIDIA CEO Jensen Huang, he expressed disappointment, naturally, but also acknowledged these larger agendas to work out between China and the United States. He even mentioned NVIDIA had already agreed to pay 15% of its sales from another chip, the H20, to the U.S. government just to get export licenses. It's complex.
Well, 15% just for the license. So it's really not just about one product. It's about control, tech sovereignty. What's the bigger strategic picture here?
If you zoom out, it's definitely not just about NVIDIA or one chip. It's a major strategic move in this global race for AI dominance and, crucially, semiconductor independence. You had House Speaker Mike Johnson calling China an adversary over this, citing intellectual property theft concerns. And China's move. It's seen partly as them showing confidence in their own domestic chip makers, like promoting Huawei's Ascend 910 Dilby as an alternative.
Right.
Although most analysts agree Huawei's chip is still years behind the most advanced Western semiconductors, but it clearly shows the direction they're heading. It's a high-stakes game.
It really is. And speaking of these big policies having real-world effects, let's look at the impact of tariffs on American farmers. It's a fascinating example of how these broad policies create very different outcomes for different people.
Totally. Trump's tougher trade policies, they're having this really mixed impact. You've got clear winners and losers, sometimes side by side. So on one hand, you have soybean farmers, like Todd Western III mentioned in the reports. They're genuinely worried. China used to be their biggest buyer, but they haven't pre-purchased soybeans for the upcoming harvest. Plus, costs for fertilizer, equipment, they're rising, and the numbers are stark. 216 U.S. farms filed for bankruptcy in 2024. That's a 55% jump. So huge pressure on sectors relying on global markets.
But then you have this other story, Indiana shrimp farmers.
Yeah, Carlinia and Darrell Brown, they're apparently thriving. Why? Because those same tariffs that are hurting soybean farmers are actually shielding the shrimp farmers from cheap foreign competition. It's a perfect illustration. Economic policies are rarely, if ever, one size fits all.
That's such a clear example of those contradictions. Okay, so while global policies are creating these complex outcomes in traditional sectors like farming, how are new technologies, especially AI, driving shifts in completely different ways? Let's talk corporate maneuvers and innovation.
Right. And what's really striking here is we're moving beyond just AI assisting humans. And we're seeing the beginnings of what they call agentic intelligence. AI that can actually do things autonomously. Take Amazon. They've just rolled out an AI agent for their 1.3 million third-party sellers. It's an enhancement to their seller assistant tool. But this thing has agentic capabilities, meaning with permission, it can actually take action on the seller's behalf, handle tedious stuff like coordinating inventory orders, drafting business growth plans, even fixing account issues. The idea is to free up the sellers to focus on innovation, customer relationships, the human stuff.
That's a big step beyond just, like, a chatbot answering questions. And it's not just Amazon, right?
No, definitely not. Kayvon Beykpour, who co-founded Periscope, he just raised $40 million for his new startup, Macroscope. They're using AI from Anthropic, Google, OpenAI to help developers find bugs in code and also give product managers tools to track engineering work, tackling what he calls the opaqueness in software development. And even Walmart got a nod from Bank of America as an emerging leader in artificial intelligence within the retail sector.
Yeah.
So yeah, AI is really starting to execute multi-step tasks, saving businesses real time and money. It's becoming operational.
Okay, shifting gears completely now, but still talking huge markets and innovation. Health, specifically the race for obesity and diabetes treatments. Big news from Eli Lilly.
Yes, potentially very big. Their experimental pill, orforglipron, apparently outperformed Novo Nordisk's oral drug, Braftosis, that's oral semaglutide, in a head-to-head trial for type 2 diabetes. The results looked pretty strong. Orforglipron, at the highest dose tested, lowered blood sugar more significantly, 2.2% versus 1.4% for Rybelsus. And the weight loss was notable too, 9.2% weight loss for orforglipron, which is about 19.7 pounds compared to 5.3%, or 11 pounds for Rybelsus in that study. Eli Lilly says they expect to apply for approval in 2026 and are aiming for a global launch around this time next year.
Wow, a pill versus injections. That's a huge convenience factor. And you mentioned this isn't just about health outcome, it's a massive market, potentially $100 billion of fierce competition for these needle-free options.
Absolutely enormous market. But it's important to add some caveats to that study. The comparison was against a lower dose of the Novo Nordisk pill, 14 milligrams. Novo is actually testing higher doses, 25 or 50 milligrams, specifically for obesity. So experts are saying, hold on, it's too early to declare orforglipron the clear winner, especially for obesity or against those higher doses. Also, side effects mostly mild to moderate GI issues, which is common for this class of drugs. But orforglipron did have a higher rate of people stopping the trial because of side effects, 9.7% versus 4.9% for Rybelsus. Something to keep an eye on.
Okay, important context there. Good to know. All right, let's quickly round out with some other corporate news and market activity that caught our eye, starting with investor influence.
Yeah, a couple of things. Workday shares jumped 7%. Why? Activist investor Elliott Management revealed they've taken a $2 billion stake. And they're supporting Workday's current multi-year plan for improvements. Interesting to see an activist being supportive, not just demanding change. And speaking of market leaders, Jim Cramer floated the idea that JP Morgan could be the next non-tech company to hit a $1 trillion valuation. They're around $850 billion now.
Yeah.
He cited their broad strengths and Jamie Dimon's leadership. Quite a call.
$1 trillion. Wow. Okay, from investor plays to customer power. Cracker Barrel had a rough quarter, stock sank 10% after earnings. But what's really interesting is they actually reversed their whole rebrand plan, new logo, store remodels, because customers hated it. Intense backlash. They switched back to the old-timer logo, refocused on guest experience, and actually regained some market value. It's such a clear reminder, isn't it? Listen to your customers.
Absolutely. Adaptability and listening are key. Customer loyalty is fragile. Okay, so from customer sentiment to market debuts, StubHub finally went public. Yeah, after a couple of delays, once in July 24, again this April, blamed on market volatility, including those Trump tariffs. They debuted on the NYSE at $25.35. But it didn't hold. Dropped about 6.4% to close at $22. Still valued the company at around $8.1 billion, though. A bit of a bumpy start.
And sticking with live events for a second, Live Nation CEO Michael Rapino made the argument that concert tickets, despite all the headlines about high prices, are actually still relatively underpriced compared to sports tickets.
Interesting perspective.
Yeah, and the live music industry itself is projected to grow pretty steadily, like 7.2% annually through 2030. Millennials and Gen Z are driving that. Plus, touring is now the main income for many artists. Think Beyoncé's massive tour. It shows a real shift in how entertainment value is generated and consumed.
Definitely a changing landscape. And finally, just a very quick look at Asia markets to wrap up the corporate picture. Hong Kong's Hang Seng Index saw a nice climb, 1.78%, and the tech index jumped over 4%. Baidu surged 14%, partly on news of a big bond offering and an AI deal. South Korea's Kospi hit a record high after the government scrapped a planned tax hike. But on the other side, Singapore's non-oil exports, they plunged 11.3%. So really a mixed picture across the region.
Wow. Okay, what a week, what a roundup. We've covered a lot today. We've seen these really intricate economic decisions from the Fed, the geopolitical chess moves playing out in tech between the U.S. and China, and some major corporate stories unfolding. Everything from the Fed's delicate interest rate dance and what it means for your budget to that intense U.S.-China tech rivalry and how big companies are trying to adapt, whether it's through, cutting-edge AI or just listening to customer feedback and hitting pause on a rebrand.
It really paints a picture of constant flux, doesn't it? And maybe that leads us to a final thought for you, our listeners, to chew on. In this world where AI is starting to take over tedious tasks, where global politics are literally redrawing supply chains, and even the price of, say, a concert ticket is sparking debate, what fundamental human needs or desires are still, immune to all these accelerating changes? And maybe more importantly, how could understanding those constants and things that don't change help us better navigate this future that seems to be just perpetually shifting under our feet?